Number 2, diversification, worldwide diversification and diversification in asset classes with different correlations. We're going to go over what correlations means today. So here's a fact, right? An undeniable fact. If you or I or anyone else could forecast the future, we wouldn't need to diversify. Why would you want to diversify? It would be like having tomorrow's newspaper today. We would just take all our money and bet it on the thing that's going to have the best performance the following day. It's just impossible. So why do we diversify? We diversify because negative returns are disproportionately more damaging to a portfolio than positive returns of the same size. And here's how the math works on that. 20% loss requires a 25% gain. If you're in an all-stock portfolio, this kind of volatility happens all the time. That's normal. So if you have a 20% loss, this can come just as fast. So that's not really a big deal if you're in a 100% stock portfolio. But where it gets bad is if you speculate and gamble and start losing big sums, or you become a victim of fraud. 50% loss requires a 100% gain. Here's the math. You have $100,000. You lose 50%. Now you have $50,000, right? So if you make 50% or 50% back on $50,000, you're only back to $75,000. It takes 100% gain to get back to your $100,000. And here's where it gets really bad. 75% loss requires a 300% gain. That's why when people are devastated by fraud or speculating and gambling, they can't make that back up. It's a lifetime decision. So what is diversification? Diversification is sometimes we have assets that are performing differently at different times, and that's what we want. Sometimes there'll be something that's performing really well. There might be something that's not performing so well. That's okay in a diversified portfolio because that will change over time, and that's why we rebalance. And Scott and I, we pay a lot of money for this kind of expensive software to analyze investments, and we can get these numbers from the software. Across the top, you see all kinds of asset classes, the U.S. asset classes, international emerging markets, and then your fixed income or your bonds, and then the same asset classes on this side. And you'll see a correlation of 1 means they're going to go up and down together, right? So you have international small and international small are obviously the same asset class, so they're going to have an exact correlation. If you have international large and international small, they have a 0.82. They are fairly correlated together. But if you have international large and 5-year U.S. Treasuries, you'll see here the fixed income, the bond portion, has very, very low correlations to stocks. That's why we have them in the portfolio. And I'll show you a little bit later on more reasons why we have them in the portfolio. So you can kind of see, same thing with some have about half the correlation, emerging markets and international large, and then U.S. small value and emerging markets. So there's reasons for having different asset classes in your allocations. Here's what that looks like in real life. We know we had a recent downturn, right? And during that down period, I found this one day on February 5th, 2018, the S&P 500 was down 4% that day, all in one day. But check this out. Now, all of our stock allocations were down considerably that day too, but look at the bonds on that day. They were up for that day because they have low correlation, and sometimes they'll be up when the stocks are down. Now, there'll be other days when they might go down together and they might go up together, but it's very rare. They usually have some sort of opposite effect. So diversification, never make a killing, never get killed. The never get killed is the most important part of that equation. So here's Jim Cramer's idea of diversification.
Crystal ball, I see nothing but devastation in your future. Please don't make me mad. Get it? Pros lose money all the time. You can probably do better on your own, right? Wrong! But this is a stock show. How many stocks? I got that figured out. No more than 10. Saying it again because people keep asking about this. No more than 10 stocks but no less than 5. You cannot be diversified with fewer than 5 stocks.
Fewer than 5 stocks, but no more than 10. So here's the problem with that advice. He comes on the TV probably a couple hundred days out of the year, you know, with vacations and holidays and weekends and stuff like that. And every day he comes on TV, he gives what? Advice on stock picks. So out of 200 days, he might have 300, 400, 500 different stock picks for you to consider. But you're only supposed to pick 10? What if you pick the ones he got horribly wrong? And he does get some horribly wrong. He gets some right too. But when you're doing stock picks all the time, are you going to get some right? Absolutely. And then around the world, 52 different countries in our portfolios. Now, the US is the biggest free market and the strongest company in the world. We know that, right? So we have 60% of our stock allocation is in the US and 40% is in the rest of the world. And then when you see these little small countries, it might be a fraction of a percent in the portfolio. So most of our money, of course, is going to be in the US, but there are a lot of times when the international markets do far better than the US. So we want to own some of that. So in your investment policy statement, I'm going to read this to you. This is what we say on diversification. The portfolios will diversify and seek to reduce risk and volatility by investing in funds that may contain stocks, bonds, cash, currency, commodities, and real estate, both domestic and international. There may be additional risk when investing globally and in high book-to-market stocks, such as value investing strategies, kind of like the Warren Buffett style of investing. He looks for value companies. However, Royal American Financial Advisors believes it is better to remain diversified globally, and with this additional diversification, risk can be reduced over time with discipline and rebalancing strategies. With a global strategy, there may be times when global investments underperform U.S. markets for extended periods of time, and vice versa. We have to remember that vice versa part. Likewise, there might be periods of time when value investing underperforms growth investing strategies for extended period of time, and vice versa. That's why we own both growth and value in the portfolio. Royal American Financial Advisors believes these periods of time cannot be determined in advance and is the primary reason for implementing diversification and rebalancing strategies. So it's extremely hard for many investors to remain diversified because diversification is a double-edged sword. You're never going to be in the best portfolio, you're never going to be in the worst one either. But instinctively, we all want to be in the best one, right? We all want to be the best. So here's a bunch of different asset classes. Large companies, international companies, small companies, a diversified allocation, fixed income, all those different asset classes from 1998 to 2017. You'll see there, this is international, this light blue right here that I just circled. You can see sometimes it's at the top, sometimes it's at the bottom. Same thing with US. But look at the diversified allocations of 65% stocks and 35% bonds. Always around the middle. That's the beauty of diversification.